I think overall we continue to feel that the market's going to be challenged. General view that rates are going to be higher for longer, and with affordability likely to be negatively impacted from the continuation of constraints on available supply. And while incomes, might start to grow, we're still going to see upward pressure that might alleviate the problems that we see at the entry level. The overall market is going to continue to be in what we call a slow grind higher, but not that optimistic for a significant growth.
Prominent CEOs, leading economists, iconic investors, insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Welcome to another Walker Webcast. It is my great pleasure to have my friend, colleague, and incredibly insightful analyst into the housing markets, Ivy Zelman, joining me today. As I posted out on LinkedIn yesterday, after having had Mohammed El Arian to begin 2025, followed by Peter Linneman, and now followed by Ivy Zelman, I feel like I ought to get some honorary doctorate in economics, given the amount of homework I've had to do to be able to talk to these three great minds as it relates to the world we live in, the economies we're living in, and what to look forward to in 2025 and beyond. I also have to say that when the tragic fires hit California and we started to see the destruction evolve, I reached out to Ivy and said, there's so many questions out there as it relates to the impact that these fires are going to have from a housing standpoint, from an economic standpoint. Could you come on and have a conversation about that? And Ivy was generous enough to say, and in typical Ivy fashion, I'm not the world's expert on a lot of those issues, but I'm happy to take what we do at Zelman from a housing standpoint and try and give some thoughts and ideas as it relates to the impact that the fires may have as it relates to the housing industry. So we are going to touch on that a little bit today, but most of what Ivy and I are going to talk about is Zelman's Housing Macro Forecast, which to anyone who hasn't read it is an incredibly good read that talks about where the housing markets in the United States are today, where they are going to go for the next couple of years, and what Ivy and her team tell us all we should be looking at and thinking about as it relates to where to place your bets and where prices are going to go, et cetera, et cetera. Before I open the conversation, finally, I will just say I did mention the California fires. I was just in LA this past weekend. The destruction is obviously tragic, and the loss of homes and lives and community is something that many people in the LA region and across the country are mourning. And so to those people, we have colleagues at Walker & Dunlop who have lost their homes. We have plenty of clients and friends who have lost their homes. We are obviously thinking about all of you, helping however we can to get you all back up and going. And the rebuild in Pacific Palisades and other areas in LA County is going to take some real time. And I think Ivy and I are going to jump in a little bit there on what the state of California has done and hasn't done to try and accelerate that recovery process. Ivy, welcome. Nice to see you.
Nice to see you. Thanks for having me.
It's great to see you. So President Trump inaugurated on Monday. Here we are on Wednesday. There's been a flurry of executive orders. The stock market has been up the past 2 days. The 10-year has stayed relatively flat from rallying after last week's economic news that looked like inflation was a little bit more under control than many had thought when the 10-year had gotten up to 4.80. Just before we dive into specifics, Ivy, as we begin the year, kind of how are you feeling as it relates to the overall housing industry and the outlook as it relates to rates, growth, public policy, just a general kind of, you feeling good? You feeling pessimistic, optimistic? Where's your head?
I think overall we continue to feel that the market's going to be challenged. Affordability is significantly stretched. We have no question I guess general view that rates are going to be higher for longer, And with affordability likely to be negatively impacted from the continuation of constraints on available supply, home prices are likely, in our opinion, to still move higher. And while incomes, might start to grow in more parity with home prices, we're still going to see upward pressure that might alleviate the problems that we see at the entry level. Predominantly, the move up market remains pretty healthy, and we're more optimistic there. But generally, I think the overall market is going to continue to be in what we call a slow grind higher, but not that optimistic for I guess a significant growth.
So you talked about rates being higher for longer, Ivy. In this update, the first slide you put out there is Zelman's projections on where single-family mortgage rates, which obviously are tied to the 10-year. But we're going to talk about this from a single-family mortgage rate standpoint. One of the biggest shifts was from September to January, where your forward look on where rates will be in 26 moved from being at a 660 level, from a 580 level to a 660 level. So up from a 580 projection for where single-family mortgage rates would be in 2026 up to 660. That 70 basis point shift in your outlook. Talk for a moment about how that then sort of impacts every, if you will, input into your models as it relates to starts, as it relates to absorption, as it relates to all the other factors that play into the housing market.
First, I would say that 70 basis point increase is really what the forward yield curve is pricing in. So we wanted to show you from a timing perspective how quickly the market is pricing in higher rates as it relates to single family mortgages. So that's really not our forecast. That's just what the forward yield curve is forecasting. But as you said, it impacts all aspects of our forecast. So while we look at the impacts it has on volume, we had to reduce our existing home sale forecast modestly as a result of rates backing up. We've also looked at slightly reducing our new home sale forecast. We've got home prices that are going to decelerate at a maybe faster rate than we had anticipated initially. So under this scenario of rates higher for longer and that 70 basis point increase, it just basically shaves off growth and reduces acceleration in home prices.
Start a legacy. Start turning dreams into realities. A better world begins with you. Better communities start with us.
One of the components, obviously, of rates being higher for longer is the Fed not getting inflation completely under control, getting to a target rate that they have had for quite some time of 2%, and then everything else would cascade off of that. And there's been plenty of conversation about the fact that they'll adjust and be closer to a 2.5 to a 3% inflation rate, and then you'll have short-term rates as well as the long bond play off of that. One of the big inputs there is whether tariffs come up and whether there's big inflationary pressures because of those tariffs. You all have projected that you kind of, as I read your analysis, it was there's some good, which is the deregulatory efforts and the tax cuts, which are modestly positive, but there's also some very significant headwinds as it relates to the unrest in the labor markets due to any deportations or anything on an immigration standpoint, and then also tariffs being negative. You all price in a 4 to 6% price increase if all of the Trump tariffs are enacted. Talk for a moment about if that 4 to 6% price impact on housing, how broad is that as it relates to the inflation print? Because I would think that when you all have built in 4 to 6% price increases on the cost of homes, that's taking into account a lot of the inputs into that CPI. So if that is the case as it relates to housing, you play that out more broadly, and your take would be that there are going to be some significant inflationary pressures if these tariffs are enacted.
Yeah, I think that what we did was we asked our industry contacts that are building product manufacturers and distributors what they thought the impact would be across of their various products that they produce. And that was the collective feedback, 4 to 6%. As it relates to the actual home price, however, that doesn't necessarily mean that they'll be able to pass that along to the consumer. And what we've seen currently is a lot of pushback that's only now beginning for builders that are incentivizing to actually achieve absorption are starting to do a little pushback to their suppliers as it relates to building materials. So the hope of the building product manufacturers and distributors is we'll be able to pass those price increases through to the builder customer and or the remodel customer. But in reality, they might not be able to get the full offset. So it may not be as inflationary as maybe some people fear if their customer, being the builder and or contractors, say, we can't take that price increase because we can't pass it along to the consumer. On the other hand, if the builder does take that price increase, it just means more upward pressure on price, which just again extends the challenge of very stretched affordability. So I think it's a lose-lose either way. I mean, it's a lose for the builder if they are, not able to pass it on to the consumer because they're going to see margin pressure, which they're already feeling because of their need to incentivize. But with that said, I do think that there is risk that not only that headwind from higher inflation will create more inflation in the shelter component and the home furnishing component of CPI over a longer term period, but we also have the risk of labor, which is definitely more of a concern, in my opinion, than even the tariffs, because even though many of the builder industry executives that we've spoken to about the risk of deportation feel as if they don't have those illegal citizens now or illegal people living and working for them, many of the trades that they use may not have on staff people that are living here illegally, but they sub out so much of their work and it just kind of trickles down. So I think there's a little bit too much complacency amongst the industry as it relates to the risk of deportation, as it relates to at least the construction industry. I think it could be more impacted than people are anticipating. And that we already have an aging workforce, and there's a lot of parts of the food chain for the laborers of various trades that could be really impacted, especially at the more, basic entry type products like hanging wallboard or some of the things that don't have a lot of complexity to it.
So I want to get your read on lumber and concrete, given the importance of Canada and Mexico as it relates to the lumber market as well as concrete. But I want to loop back to that after this question, which is that your comment about labor. You also in this deck talk about how the public home builders have now surpassed the private home builders as it relates to overall production of single-family homes, and that's a dramatic change. The data point you put in the research is that back in 2005, the independents were producing over 800,000 homes a year, and the publicly traded home builders were producing about 400,000. Now the publics are over the privates, and the privates actually are well below it, and the publics are at, I think, 480 now. And so the publics have continued to gain share. Does the public home builders and their need to have legal labor put a little bit less pressure on that issue than it would have been if you were to go back to 2005, where you had so many independents who might not have the same standards from a labor hiring standpoint that the publicly traded companies do?
Absolutely. I think back pre-GFC, I think the numbers were close to 3 to 4 out of 7 were illegals. And when Trump came into office in 2016, there were a lot of raids at that time on job sites and a need for e-verification. So I feel like the builders, the public builders, especially that have very large trade partners, they feel very much ready for any risk, and they feel like their risk has been reduced substantially. And just to put it in perspective, you gave a lot of numbers around the absolute level of orders for builders or new home sales. The publics account for about 54% of the new home market today. And just to give you a perspective, when I started covering the industry 30 years ago, that number was in the high single digits. So they've dramatically consolidated the industry, and there's more to come. And one of the benefits they have is as they have great trade partners that are larger companies, the risk is definitely less prevalent than it is for private builders that are really more dependent on smaller independent trade partners, many of which they do have the same, but there's no question there's going to be that puzzle with so many different pieces. There's going to be areas that I think are more impacted than others. And as I said, the commodity type products, on installing those products, are typically where you see more people that are likely to be illegal.
And Ivy, just to go a little bit deeper on that, why is it that the publics are, I mean, why is there so much consolidation going? My tummy would tell me it's not that there are a lot of independents who are basically saying, I'm for sale. It's more that the economies of scale and the efficiencies and the ability to provide financing and all the other ancillary services that have been built into the single-family home building market is why the publics are being able to grow and take market share to the degree that they are. Am I missing something in that kind of back of the envelope analysis, or is that essentially what's happening?
That's essentially what's happening. I would add that the primary part of their benefit is their cost of capital is anywhere from 500 to 1,000 basis points lower than private companies. I do think that they're both growing organically and through acquisition to obtain the market share growth that they've had. So they're doing it in both fashions. And I would say that they also have, because of lower cost of capital, they have the ability to pay more for land. And by paying more for land, they can bring more communities to market. So they're seeing the benefit of the absorptions at a higher pace, not to mention they can afford to do mortgage rate buy downs. And a lot of the private builders are really suffering, especially when they're bank financed, and there are probably curtailments on how much they can really reduce margin by. So that's economies of scale, ancillary businesses, cost of capital, and they're really continuing that sort of cycle of that capital flowing from, their various businesses, allowing them to have competitive advantage. It really is, I think, somewhat discouraging for the privates, but there are many regional privates or even local privates that do very well and have more of a philosophy. I'm not going to play in the sandbox with the publics. I'm going to find something that's nichey, differentiated, and they could do very well on their own. But there's no question. My advice to the privates is if the publics need volume, they need growth, it'd be great to partner with them, sell, do an earn out. But it to me, it's inevitable that there's just going to be more pressure on the privates than the publics today. And let me clarify, when we look at some of the feedback, we ask all our private builders and publics, do you feel that there's risk from deportation to your operations? And many of them want to clarify that many of their various trades have people that might be here that are yet living as citizens, but they aren't US citizens, but they're not here illegally, and they are here for a number of months, and then they go back to Mexico or whatever country they're from. So they're not as concerned about deportation generally, but I probably am a little bit more cynical about it and think there's like just, I don't know, downward backlash from, realizing that you are, for example, there was a raid in, I think, Bakersfield, California recently, and there were literally like 8 workers showed up when there should have been dozens that showed up. And I know that one of the executives from one of the public builders showed up and said, what's going on? And many people don't come to work, not because they're illegal, but maybe they're someone in their household might be illegal. And they're concerned if they answer the door, then they're going to say, you're here illegally. They want to protect their family members. So even if they're legally here, their family members not be, and that has a ripple effect that's impacting their ability or in desire to show up to work.
Talked about rate buy downs by the publics, and that being an important component. One of the data points that I was struck by in this research report was that the average mortgage spread on a single family mortgage sits at 230 basis points today. That's down from 300 basis points last year. But the average historic has been 165 to 175 basis points. Why is the spread on single family so wide today, given what is in the commercial space and in the corporate bond space, almost historically tight spreads?
There have been several, opinions as to why the spreads got as high as 300. One of which is that the incremental buyer of mortgage-backed securities generally started to decline by the Fed and by banks. And the Fed was more in runoff in terms of MBS, and banks pulled back by their requirements and capital requirements and weren't buying as much MBS. So that's one of the biggest reasons. The second was risk of delinquency. And if the economy was at one point where we're going into a hard landing, and therefore the MBS investors are looking for a higher rate of return, then as we were seeing rates rallying, then there was prepayment risk. So prepayments as rates come down and there's people that are refinancing out, that also hurts the MBS returns. So those are some of the major potential reasons why spreads have been so wide relative to historic norms. And we've seen the spreads actually compress along with the yield curve de-inverting and normalizing. So we expect spreads to continue to compress, which would be favorable for mortgage rates, better than maybe the forward yield curve is implying. And what's been really, I think, very favorable is the resiliency of demand even with mortgage rates hovering near 7%. And I do believe that the housing market will continue to see strong demand despite mortgage rates at 7. And that has been a surprise to myself, but predominantly because of the job market being as strong as it is, and also the lack of available supply. So demand is still allowing for decent absorption growth, but I don't think that builders are going to have the pricing power that they've had historically. And I think they realize that. That's why they continue to provide those incentives, predominantly mortgage rate buydowns.
What about if you will, the release on the lock-in effect? So your data says that about 75% of American homeowners who have a mortgage on their home have a rate below 5%. So we've just been talking here about, your projection on the forward curve that's saying, you're going to have 6.50 to 7% rates on single family. That's got a long way to go to get down to something where someone who has a 5% or less mortgage is willing to give up that cheap cost of financing to go and potentially buy a new home and sell their existing home. How firm is that lock-in, Ivy, in the sense that are you seeing people who just sit there and say, that is such a great financial asset that I'll put lots of home repairs on my home. I'll stick with this for a longer period of time. I think, it's been a relatively short period of time since all those new mortgages were put on in 21 and the beginning of 22. So there hasn't been that much. But do you see that easing up at all as it relates to existing home sales coming onto the market? Or do you think that lock-in effect really does put massive downward pressure on existing home sales for the foreseeable future?
I think that we're going to see that the lock-in impact will keep existing turnover well below historic trends. Now, we are seeing through the end of the year, inventories nationally were up 15 to 20%, which actually is still very low relative to any historic period and would put us still below nationally where we were pre-COVID, when pretty much the market went nuts post-COVID, or during COVID. But I would say that when you look at the lock-in effect, what starts to happen is some people will keep the home, move, but rent it out. So they don't want to lose the asset because it's a cheap cost of capital. And that might be an opportunity for them to retain the asset and get home appreciation longer term. Alternatively, if they're moving, and let's say there's an arbitrage where they're moving from New York to Florida, well, maybe not Florida anymore, New York to, let's say, a more affordable market, or east to west, or east or Midwest to Southwest, a lot of that arbitrage might allow for them to overcome the lock-in effect. But today, by seeing inventories rising in areas, MSAs in Florida, for example, where we've seen inventories rise the most, up north of 50, 60, 70%, a lot of those people are saying, you know what, I don't need to have a home here that my cost of capital is now much higher to maintain the house. Insurance is much higher. And they're looking at the impact overall, not just the actual mortgage rate, but the other attributes of being a homeowner. And definitely property taxes, homeowners insurance are, I think, causing many people to rethink homeownership in certain part of the country. And we are seeing a big divergence between markets that have more inventory rising than markets are still constrained. So you're seeing, for example, in my hometown of Cleveland, home prices are up through 24, we're up 8%. Whereas there are markets in Florida where home prices are, marginally up or even down. So we see a big divergence in markets where inventories are rising, but I don't think it's just about the lock-in effect. But to answer your question more directly, we think existing turnover will remain in a modest growth period for 25 and 26. We're only looking at, call it 5 to 9% respectively for the 2 years, but that's well below historic trend line. And if you think about it from a percent of existing home sale closings over households, historically we would be over 4.5%. We're still going to be in the threes, and that's like historic recessionary lows. So the lock-in effect will keep demand or turnover low, but we are starting to see increases, and I think that will continue. And people get to a point, Willie, where, you know what, my kids have left, I'm an empty nester, this house is too big for me, I have a lot of equity, I'm going to downsize, or I'm going to relocate to a warmer climate. There's lots of mobility that happen. Realtors like to joke in a recession, there'll always be the 3 Ds to create transactions: death, divorce, default. And even in a economy where we don't have risk of default, you have discretionary buyers and sellers that start to get really tired of waiting. And I think we're seeing some of that now, where it's their life style is they're at a situation, at life inflection point where they need to move. So modest growth at best and still below historic trend line.
So when I hear you talk about modest growth of existing home sales, I sit there and say it's just an incredible opportunity for the home builders to go meet the demand. Yet your projection as it relates to new home sales you have 680,000 for 2024, 715 for 2025, and 750,000 for 2026. Those seem like relatively I don't want to. Yeah, they just doesn't. It seems like there's such an opportunity here, given the lock-in effect, for the new home market to meet the demand. And even if it was a price issue where many people are priced out, that they would adjust and go and meet a lower price point to be able to capture the demand for single family housing. Yet your numbers don't have that. It feels like there's constraints on both ends, both on the existing supply as well as on the new supply. What am I missing there?
Well, first of all, I just want to compliment you. You know my numbers better than me. I don't know if you've got a screen up and you're cheating over there, but you know them, and it's very impressive. But generally speaking, the growth that we're anticipating in the new home market is 5% per year in 2025 and 26. That may seem modest, but it's really what we have the ability to look at the front line, which is land purchases. So we're watching land purchases, which then get developed and then actually translate into community count. So when we look at the public builders community count, they're really only growing, call it 5 to 10% on average. They're opening new stores, as we like to call it. And part of that are the constraints of just getting entitlements, getting to permit, and the difficulties of the constraints that they have on the front end of their machine. Not to mention, when they try to grow starts north of 10, they start to run into issues. Labor becomes very challenging. They have supply chain issues. So it's almost like the system breaks down when you get into double-digit territory on growth. So I think they've been more prudent about how much they're going to deliver in new communities. And right now, frankly, they have a lot of spec on the ground. So they were starting a lot more homes in 24 that they wound up getting in trouble with, and they didn't move them as fast as they would have liked. So they've actually dialed back on starts, and we only expect starts to grow for single family production sales in the 3% range for 2025 and 26. So it's really, I think, constraints that they have coupled with their inability to move the spec that they have on the ground as fast as they would like. And that's just absorptions that are still healthy, but maybe not as robust as they expected. I don't know if that helps clarify it, but I think they're being prudent. I think it makes sense not to push on the gas too hard, especially when you're sitting on specs that aren't moving as quickly as you'd like.
So two things on that. One is, if you look back to your 2005 data as it relates to the independents versus the publics, the big surge in home building back in 2005 was by the independents. And so I would put forth that you probably have a little bit more constraint right now, given the size, scale, and number of people who are looking at the publics as it relates to the risks that they take at this point in the cycle. Whereas maybe back in 2005, heading into the housing crisis, some of the independents were taking, a lot of risks at that point, just trying to meet a forward demand curve that ended up falling apart on them. You may or may not. I'd love to hear whether you agree or disagree with that. And then I wanted to go to President Trump's executive order that he passed yesterday, and whether you think that actually brings any relief to the issues that you brought up. But on my quick back of the envelope as it relates to 2005 and the risk taken by independents versus the publics, do you think that there's a little bit more risk aversion given how the publics are dominating the market today versus back pre-housing crisis?
I would say that the publics took a lot of risk during those boom years, the go-go days with rates where they were down, and there was a lot more activity by both publics and privates. And so over the time frame that we're talking about, I don't know, they learned a lot through the downturn. I think, we used to say they were nearly 6 feet under. And by getting, surviving the GFC, the definite totally revamped how they go to market and how much land they're willing to hold and the size of the parcels they're willing to hold. So the publics were very aggressive. The difference was that the privates, a lot of them didn't survive, or they sold out to the publics later on. And I think that's been part of the story. But today, the publics are much more prudent than they were in the 2005 timeframe, no question about it. And that's where I compliment them, because they're not trying to step on the gas and just jam out more inventory, more supply. in what could be obviously put the shareholders more at risk. So they're definitely more focused on driving cash flow, keeping their leverage low, and really returning more to shareholders. And that's more important to them than top line growth. It's return on invested capital is really, most of them are today employing that philosophy. And I think that it will pay dividends for them with assumingly higher multiples eventually. But today they're definitely more prudent, and they would argue that they weren't prudent. They would admit it during the GFC or pre-GFC.
Yeah. So on the comments as it relates to regulation and the difficulty for home builders to actually get land entitled and start to build and get building permits and all that has added so much to the struggles of adding inventory that gets us to a point where we don't have a shortage of housing in America and get some actual price relief. President Trump passed an executive order when he immediately got into office, talking about the need to deliver emergency price relief to American homeowners. There were very few specifics, Ivy, in the executive order that he signed, but given that it was one of the first things that he signed, getting some type of relief into the housing markets is clearly top of mind for President Trump and his administration. Understanding that, A, you're not in the president's mind, nor there weren't many specifics on there, what would you think they might actually do after having an executive order passed where every 30 days his cabinet needs to come back to him and say, what are you doing to make emergency price relief for American homeowners?
I think at the federal level, whether they're working with the governors and trying to figure out what type of tax credits they can provide local municipalities, enabling them to fast track more of the permitting, relax regulation, they have to work together. It has to start with the local municipality, and whether that starts at the state level with the governor, then working with the various MSAs. I think it's got to be some tax relief, because it's not going to, they can't change land prices. And they do have federal land. During the campaign, President Trump talked about taking federal owned land and figuring out how to provide that supply to builders to build more affordable housing. But today in the United States, federally owned land is about 30% of the US land, but it's very much west of the Mississippi and in more rural parts of the country. We don't really anticipate that trades are going to be willing to go that far out, nor will home buyers. But when you think about what would really accelerate more affordable housing, we have a lot of NIMBYism in the market. We have a lot of opposition that people still have perception-wise. It really has to start at the local level. And I don't know how the federal government does that without providing some type of incentive, maybe through more tax credits, something that would really give those local municipalities more motivation to provide that supply and accelerate it.
Do you think that, as you think about the President Trump's focus on tariffs, is an executive order saying we want to bring down the cost of housing and at the same time putting up a proposal to put 25% tariffs on Canada and Mexico? And this is kind of looping back to the question I wanted to ask earlier as it relates to so much of our lumber comes from Canada and so much of our concrete comes from Mexico. Those two things don't work together, if you will, of putting up significant tariffs on Mexico and on Canada, and at the same time putting emergency relief to the cost of housing in America. Talk for a moment as it relates to those costs of inputs being so important to the housing industry and would clearly get tagged if we had significant tariffs put in with Canada and with Mexico.
No, there's no question. It definitely doesn't match up with the goal to reduce, the cost of living or provide more affordable housing. And I think that many of the builders we spoke to about the risk that tariffs would have on their ability to, provide more shelter at affordable prices, their view would be that that's really a big stick that Trump's using just to negotiate with Canada and Mexico. They're a bit complacent that the full amounts would go through, but nevertheless, lumber being the largest, at least component with respect to the cost of goods sold for builders, they really feel that. And I think concrete definitely as well. So I think they are opposing, overall measures that the president is trying to enforce. And we would just wait and see. It's too difficult to try to understand how to connect the dots there. Doesn't make any sense, especially in light of the idea that he's also contemplating, thinking about an exit for the GSEs, which I don't have enough insight to provide, but we do think if the GSEs were to exit, that would only raise the cost of mortgages further.
Yeah, it's interesting on that. And you and I could dive into this deep, but I think I'm going to stay on other topics that are, if you will, things that we actually know are going to happen versus things that we're just projecting may or may not happen. But I do find it interesting that the difference in the single family mortgage versus the multifamily mortgage market as it relates to the view on Fannie and Freddie and conservatorship versus being privatized again, to the extent that in the single family mortgage market, the majority of single family mortgages are bought by Fannie and Freddie. And as long as it is a conforming mortgage, it's essentially an algorithm that's buying the mortgage and packaging it and then selling it off. Whereas in the multifamily industry, so much of what we do to get a mortgage underwritten and bought by the agencies has a huge amount of human interaction, where we're not only reliant upon the people of Fannie and Freddie, but also the systems and the technology that they've invested in. And so I do get this sense that on the single family side, there's a little bit of, if it ain't broke, don't fix it. Whereas on the multifamily side, it's saying the market is evolving. The originators on the multifamily side are investing in systems and processes to try and speed things up. And then it gets into the secondary market, where for all great intentions and a lot of investment, it might not be keeping up. And as a result of that, there seems to be a little bit of a different view on the potential privatization of Fannie and Freddie between the single family world and the multifamily world. And we'll see how that plays out as the policy objective is put into place of either getting them back out of the federal government, keeping them in the federal government. And I would put one other piece out there, Ivy, which is this. I think that if it's done from a theoretical standpoint, that Fannie and Freddie were never intended to be part of the federal government and they just ought to be out on their own, that's a reasonably lengthy, very nuanced process with a lot of input as it relates to what's the footprint look like, what are they going to do in the future, what's the guarantee, et cetera, et cetera. Whereas if it is teed up as an offset to either additional tax cuts or the reinstating of the existing tax code, that if it's used as an offset to that, the privatization of Fannie and Freddie takes on a completely different view, to the extent where the administration will be wanting to maximize revenues, maximize the IPO value of them. And that could actually change the entire calculus to the point where let's not debate about a explicit or implicit government guarantee. To get the maximum price, it needs to either be an explicit guarantee or a very sturdy implicit guarantee. And that all the nuanced issues kind of go out in the wash as they focus on, we need to raise $200 billion from the privatization of Fannie and Freddie to offset the tax bill. And I think that that's a very different debate than just let's take a look at getting Fannie and Freddie out of the federal government.
Yeah, in theory, it sounds great. I'd love to get into the mechanics of that and how their driving returns are going to be impacting LLPAs and some of the, drivers of the pricing mortgages. So I'll be open to, learning more. But as of right now, I'd say the jury's out. I don't have enough devil in the details to give you really an opinion.
I do think one of the other things about it is it will be interesting to see how President Trump looks at this issue, as well as, you look at him talking about TikTok and about the value of TikTok either continuing to operate in the United States, where it's got a $1 trillion valuation on the firm, or it can't continue to operate in the United States and it's zero. And the president talking about potentially the United States government getting some return, getting some equity in TikTok if he is to allow them to continue to operate in the United States. And so it's very evident that we now have a commander-in-chief who is also a negotiator-in-chief, and how the United States government plays in some of these things. I think it's uncharted territory. And I think one of the things that is very important on this as it relates to if it is included in discussions on the tax bill is that all of the nuance that you and I know very, very well, just implicit, explicit guarantee, for instance, are issues that I think go out the window as it relates to, I'm going to raise X amount of money to offset tax cuts. Tax cuts are very important. Raise the maximum amount of money out of the privatization of Fannie and Freddie to offset them. Go get it done. So I hear you. Devil is totally going to be in the details. And we obviously have a new HUD secretary. We have a nominee to be the new director of FHFA. And what those two gentlemen, and then who Secretary of the Treasury Scott Bessent puts in to be the, if you will, chief champion of privatization of Fannie and Freddie, if that is the directive from the White House? And then also, does it go an administrative route or does it go a legislative route? And obviously, if it goes legislative, it's Tim Scott on banking and French Hill on financial services in the House who would be leading that charge, versus on an administrative action, that would be up to Treasury Secretary Bessent working with FHFA. So very different paths.
Sure. I guess we'll have to see.
Very much so. So one of the things, Ivy, just looping back on housing and your projections, you have new home sales up 5% a year for 25 and 26. We've talked about sort of the lock-in effect, making it so that existing inventory doesn't come on market. Yet you also have a projection that volumes for brokers, single-family home brokers, are up 9% and 11% in 2025 and 2026. Where do you get that step up in volume if there's this big lock-in effect on existing inventory and you only have 5% growth on the new home inventory?
It's really coming from the increasing inventory that we're seeing come to market. And that's been much more prevalent predominantly in the South and Southwest, where we're seeing inventories rising at a pretty fast clip. And I think that gives us more confidence that we'll see increasing volume in terms of number of closings. And for the brokers, they're going to accelerate because they have higher home sale price. So their calculation is the value of the home times the number of homes. So home prices are still moving higher in our forecast. So that's how we get growth for both the existing home sale closings and the brokers. It's coming from more inventory coming to market.
And on the broker front and the financing front, Zelman has outperforms on Compass, Rocket, and Zillow right now. It doesn't sort of it doesn't surprise me that those three firms have been very technologically oriented, if you will. They've been making big investments in technology. Is the outperform just basically based off of market positioning, or does it also have embedded in that outperform that those three firms have been investing in technology potentially to a greater degree than many of their competitor firms?
I think that is a common theme, and our analyst, Ryan McKeveny, who rates those names, is really looking for companies that can grow, have secular growth in a cyclical environment. So these companies have demonstrated that they can gain share even if the market is under pressure. A lot of it could be stemming, in our opinion, from the technological investments they've made, but also their market position and their strategies that they're implementing. And definitely, whether it be Rocket, who's the definite leader in technology in the mortgage industry, or Zillow, providing an experience for their realtor clients and everyone else that's giving them more services, more opportunities to capture more business. And in Compass's case, they've really done an incredible job with technology and adding agents that have chosen them because of the technological advances that they offer them and the services they provide to their agents who are their clients. They really view their agents as their clients. So I think all three of them stand out to us because their ability to grow in an environment that is cyclically under pressure, despite that.
And on the home builder front, Ivy, one of the things that still sort of shocks me is you were extremely nice to introduce me to your friend Stuart Miller, who runs Lennar. And when Stuart and I were talking, I was asking him about sort of technological enhancements, improvements, innovation in the single-family home building space. And Stuart said to me, look, we invest a lot in this, but there's no whiz-bang technology out there today that is going to sort of revolutionize the single-family manufacturing space. We had Katerra and modular as an area that got billions and billions of dollars of investment in it, which basically fell on its face. And today it doesn't feel like there's any, obviously at the margin, there's always innovation as it relates to something might be sourced better, something might be manufactured better. But as far as a revolutionary technological shift in single family home building, there really doesn't seem to be anything on the radar screen today. Is my conversation with Stuart, which was now almost a year ago, still relevant as it relates to that? Or are you seeing something out there as it relates to 3D printed homes or manufactured homes that might be changing the industry over the next couple of years?
Sadly, we don't today. I think that there are, as you mentioned, maybe smaller initiatives that are not going to change the industry on a day or on a dime. It's certainly looking at, for example, we just launched on manufactured housing. Manufactured housing is an industry that could provide homes pretty much, within 30-day periods, and yet there's so much negative perception that needs to be overcome, and there's challenges to that industry. But that is an industry that provides homes that are available within a very quick cycle time as compared to single family completions. With that said, I think there are little pockets here and there. I know, for example, Lennar has a manufacturer in San Francisco that they can build 1 to 2 houses a week that are priced at $1 million to $2 million. I mean, that's a very small initiative that they continue to work towards bringing more homes to market. But part of the challenge that I've spoken to many about this, whether it be modular or manufacturing, is that they have to invest in the facilities, and the facilities only have so much radius logistically that they can travel. And so when you're investing in all these fixed plants, you're going to have to get a return on those. And the costs are really, they don't pencil. The numbers don't work today, according to the builders. And many of the builders are afraid to give up their trades and put all their eggs in one basket in the fear that it didn't work. And then they lose the trade partners. So I think we're still kind of where we were a year ago when you spoke to Stuart. I don't really see any significant initiatives. We'd love to see more buy-in from manufactured housing for more affordable homes. They're not that much more affordable than single family, but they are more affordable.
It's interesting that you raised that point about manufactured. From your data, in 1998, there was 375,000 manufactured homes sold in the United States. That dropped down during the GFC to only 50,000. And even today, it's only recovered back to 100,000 in 2024. So is there some obsolescence there, Ivy, that could say that there was this big surge in the 1990s of manufactured home communities, that those actual communities now are getting to a point where those manufactured homes need to be replaced, and you actually might see an uptick in the production of manufactured housing? Because clearly the entitlement issue is a real bear. And maybe to that executive order that the president put out, you talked about federal lands. Maybe there is something that says that you need to get local communities to just allow for the entitlement of land to be able to produce and build manufactured housing communities. But I have a friend of mine here in Denver who's in the space, and he said, when you show up to a town hall meeting saying you want to put in a manufactured housing community, they think you're trying to put a Superfund site in their community. It's like the most visceral reaction that communities across America have to quote unquote manufactured housing. And one of the other things is the lexicon has tried to change the manufactured housing from mobile home parks. And at the same time, everyone, at least in positions of power, seemingly across the country, still views them as mobile home parks and doesn't want them in their backyard. But on the obsolescence issue, is there something here that there was this big surge in the 1990s of the manufacturing of manufactured housing, and now here we are 20 to 30 years later, and that all of that might be getting obsolete and you need actually a renewal of that inventory?
Yeah, I think definitely you can see growth as you need those renewals, and those homes have aged and need to be replaced. But keep in mind the surge in the 90s. I followed the housing stocks back then, the manufactured housing stocks. They were definitely benefiting from loose credit, and that got them into a lot of trouble. The retailers were being financed with pretty much no stringent underwriting, and they had ability to just stock and hold inventory and then stuff the inventory or stuff the channel with inventory. So the market basically blew up, and it was really credit. So that basically put an end to that growth, and the normalization now back, south of 100,000, as you pointed out. We do see modest growth going forward. Fannie and Freddie have been working very closely to provide more clarity to underwriting that would allow for more of the manufactured homes to be delivered to on-site of builder communities. So in fact, I was in Knoxville, Tennessee, and we were in a community where there were manufactured homes side by side to site built, and you couldn't tell the difference. And some of that is in the architecture, but I think that negative perception was very difficult to overcome in that specific community until they actually saw the homes and realized, wow, these really do look the same. But if a double wide is coming down the road, no one wants that double wide in their neighborhood. So I don't know how they overcome that, but the industry is on a slow path back to growth. And we're optimistic that there could be, opportunities for the biggest players in the market, Champion and Cavco, to really deliver and be a part of the solution. And we think it makes tremendous sense, but there's a lot to overcome. But certainly I know there's a lot of initiatives that are working towards that we feel that could come to fruition, but very slowly, nothing dramatic.
We've talked about the lock-in effect on the existing inventory. We've talked about good but not extraordinary growth on the new home manufacturing side. So then one would go to say, okay, that means that either SFR, single family rental, or multifamily are going to explode because there's pent-up housing demand. You're not getting you're not getting existing inventory. You're not getting a big jump up in new inventory on the single family side. So that means SFR does really well or multifamily does really well. But as you point out in your research report, first of all, a weak for sale market does not necessarily correlate to a strong single family rental market. You have rent growth on SFR 2% up in 2025 from 8% in 21 and 22. So the bloom to some degree has come off that rose. And then you have relatively modest multifamily rent increases for 2025 of 2.2 or 2.4%. So kind of, I guess, first of all, jump on either one of those as it relates to SFR or multi, but then my bigger question is what gives? Because we know the demand drivers are out there, but we're not getting dramatic growth in any one of the distinct food groups.
Right. And I think that really is about the price of the units of shelter. So if we talk about there's a tremendous housing shortage and we look at the number of households that are not being formed because young adults are living at home longer or they're staying in a roommate situation longer, and the numbers are significantly above historic trend line in terms of those, coupling up or living at home. I think that the problem is that none of the units of shelter that you spoke of are providing truly affordable homes. And when we look at home builders today that are sitting on spec inventory and can't move that inventory without substantially incentivizing, or we have lease ups that are challenged in multifamily and in SFR because of the price that they're asking, that tells you that this is a price problem. It's not a shelter problem. It's the actual units that are being delivered at the wrong price. So if I told you today that one of the builders was going to build $700 to $1,000 a month product, whether it be, multifamily or let's say townhome, whatever, that would sell. The problem is the price. If you talk to young adults today, my oldest is 24, just graduated college a year ago, and she's, how can any of my friends afford to buy a home today or even pay the rents that they're being asked to rent and without having a roommate? And I think that's where the real challenge lies. But today I ask the question, if the shortage is as bad as everyone presumes it is, then why are we having pressure from lease up on rent prices? And why are we having spec that isn't being sold without substantial discounting? And I think that just tells me that we have an affordability problem across all of the asset classes that we offer as shelter. And that's the big problem today.
And so we've talked about public policy and what may or may not happen as it relates to tariffs, as it may deregulation, President Trump's executive order on the housing front. We've talked a little bit about whether Fannie or Freddie get privatized or not privatized and what that would end up meaning. As you think about the fires in California, Ivy, and the massive destruction of homes, there are two issues that come into play. One, does that add further inflationary pressures, if you will, as it relates to housing? Two, as it relates to building materials as we go into such a massive rebuild, does that create scarcity for raw materials, which then pushes up the cost of housing? And then the final piece, which I think is on everyone's mind, is insurance and the insurance costs, both on the single family side as well as on the multifamily side, continuing to go up at what many people who are owners in either asset class are sitting there saying it's unsustainable. Can't continue to pay this type of insurance to insure the home that I live in or the building that I own and have developed. Dive in anywhere across that perspective as it relates to the sort of the derivative effects from the fires in California and their impact on housing.
I think having talked to many builders and suppliers in the market, first on the building material inflation, many believe that it would be very local type businesses that would be impacted. It wouldn't likely be a national phenomena because the speed of the rebuild is going to be very slow, especially in areas like the Palisades, where the Palisades are not only a higher price point, but more likely custom, and they'll be slow to be rebuilt one at a time. I don't think there's a massive production home builder that's going to come in and rebuild the Palisades. With that said, though, there will be a near-term benefit for the available inventory on the market. I know there was a single family rental community that was in the, say, 60-mile vicinity that couldn't get a lease up. And they have not only leased everything, but double the price that they were asking. So they were asking $30,000 a month and they're getting $60,000 a month. So we're definitely seeing inflation, not only in single family rental prices, in multifamily, as well as home prices for sale. Everything's moving higher because families that are displaced are looking for shelter. And whether it's hotels are at occupancy or we've got lease ups happening and home sales happening, I think there is a near-term benefit, but I don't think longer term that it would be sustainable given that, it's going to be a slow rebuild. And I think that eventually we'll start to see that moderate. I do think you bring up insurance to me, insurance is one of the biggest concerns for housing overall, not only because of the cost of insurance, but the ability to get insurance. There are many people in Newport Beach, I'm friends with in Orange County, that are not being renewed and, are looking at how am I going to obtain insurance? And so when you start to look at like the FAIR plan, which is what the state offers if you can't receive insurance, they'll only pay out to 3 million. Many homes are well above 3 million in Southern California or throughout California. So you start to look at what are your alternatives, and being self-insured, that means no insurance, is really not a great option, nor can it be an option if you have a mortgage. So I think there's more people that are reconsidering whether they want to stay in areas that are really at risk, whether it be fires or floods. And that is going to cause some outbound migration. We're already hearing that from some of the markets that are adjacent, whether it be Phoenix and Vegas, that are seeing stronger activity right now as people are looking for shelter. And I think also Southern Cal, outside of the Newport Beach, Orange County area, is definitely seeing benefits from displaced families. But I don't believe that we'll have anything that this fire will result in that will be sustainable in absorption and price inflation, as we might have more longer term risk that home prices could be pressured as people start to rethink if they want to be in those markets that are at risk. I had a friend who emailed me and said, what do you think I should do? I was not in the evacuation area, but I was neighboring it. Do you think I should sell? I've had it here. I'm tired. The politics, the issues. And so I think you'll see more migration out of California. But I also think in areas where insurance premiums have moved up substantially, like in South Florida, similarly, that's why inventories probably have at least some part of the reason they've risen so much in South Florida. There's more people that are rethinking, do they want to be in a market where they have a home that's at risk of being, negatively impacted from a hurricane? So the insurance industry is in total turmoil. And many of the commissioners, like in California, wouldn't allow insurers to raise their premiums.
Right.
Now they are allowing them to raise premiums. So I think, will this change things? I think you mentioned the administration, Trump's directive to reduce the cost of housing. One thing that Trump is going to do that will help is by not requiring the type of energy codes that were being implemented that were costing on average $5,000+ a home. That will help on the margin. Whether in California right now, they'll relax some of their regulatory hurdles for permitting, like CEQA, which now the governor has said they will temporarily, that could help. But on the margin, it's tough to say today, but I do think the production home builders will eventually play a role in rebuilding the area, but not necessarily right in Palisades. I think it will be more people someone who lost a $5-10 million home may not want to buy a Lennar $1 million home, but the people that were in the neighboring areas that were impacted besides Palisades, they might be the ones that would go to look for a production builder that we cover. One of them for sure will be a beneficiary, or the higher end Toll Brothers or Shea Homes. They will be beneficiaries, I think, of the displaced families that want to stay in California that will be looking.
Do you think, Ivy, that these, you mentioned the cost of housing, and I remember coming out of the GFC, there was a lot of talk about micro units. And there were a lot of multifamily developers that were talking about, let's go build micro units. And micro units, they sort of had their day in sort of the concept phase, but they really didn't have their day as it relates to building them and having them be absorbed. As you talk about the cost of housing and building to where the market is today, do you think, A, micro units might have a run here? And then as I hear you talk about, the cost of insurance and people who live in Newport Beach who can't get insurance on their home, do you think that there might be a move towards a new and distinct multifamily housing that says to somebody you can live sort of as if you're in a single family home, but in a multifamily setup because it's built of concrete. It's got the insurance is on the owner of the building, not on you, and that they try and move it to a point where you can, to some degree, replicate a single family feel in a multifamily property. That has rarely worked. You look at, condos that have gone out and been built in South Florida and in LA, and they just haven't done that well as it relates to attracting the person who can both afford and wants to have a single family detached home. But as I sit there and think about these people who are building these multi-million-dollar homes and are either having to go to the FAIR plan to get only $2 to $3 million of coverage, or they're flying naked and they're self-insuring, I would just think that at a certain point, the losses, the stories of someone who had a total loss in Palisades, and very sorry to the person who does have a total loss in the Palisades, that they all of a sudden say, I can't keep going down this. I do want to live in California. I do want to live in Arizona. I do want to live in South Florida, but a multifamily kind of bunker type living format is better than the single family where I can't get insurance. Am I stretching that too far, or could that actually be where the markets would move?
I mean, the product that you're talking about that would need to be developed, built by a multifamily operator today may not pencil for them. It may not be economical. I wouldn't rule it out. I think that if someone were to take that risk today, you'd be looking at, class A plus plus plus, someone who's willing to, and they'd have to be much larger units. As we know, 3 bedroom plus are, very negligible as a part of the offering. So I think it would take someone who's really more risk oriented to try to develop something that might suit them. But alternatively, what I think is important to note is if you look at the insurance industry and think about how they view new home versus existing home, there's been evidence that new homes hold up better in hurricanes and fires. In fact, we've read, whether it be in the Palisades, there were homes that were recently built in the last few years that were not burnt down and are still standing. And I think part of that, I think Ron DeSantis has done work that I know he shared with Lennar that showed that the brand new homes within hurricane areas were able to withstand those hurricanes versus the existing older stock. So recognizing, putting my neck out there, is it possible over the long term that new homes will be attracting less or more favorable insurance and be better priced, and existing homes will remain under pressure because the insurers will be either unwilling to insure them or at much higher premiums, which if that's the case, then existing home prices might come under more pressure, just putting it out there, versus a new home market that would not only deserve the premium, but would obviously be able to offer maybe more attractive pricing if their buyers are paying less in insurance. Just thinking through that to me is a more likely outcome than a single family homeowner going to a multifamily that today doesn't really exist. And would it be in size? Probably not. Now, multifamily will benefit in the near term. Talking to some of our partners, our operators, they are seeing a pickup in demand in some of those ancillary markets that were, in the vicinity. But will it be sustained? As they question and likely think it won't. We'll see.
Yeah. I could keep on going. Fortunately, you and I work together, so I actually get to continue the conversation with you, but we are out of our hour. I guess, Ivy, overall, I look at the update and it's a healthy environment, but it's obviously got headwinds to it. If there's a silver bullet, if you're sitting in the White House and saying, if you really want to do something to get the type of new home development in America, you want to release the kindred spirits inside of the housing market, you ought to focus on this. What's that one thing? Is it the cost of mortgages as it relates to where interest rates are? Is it the regulation at the local level? Is it giving up on the tariff push? What's your one real, you're sitting at the Resolute desk with the president saying, Mr. President, with great respect to all the policy initiatives you have right now, if you really want to get housing going, this is where you ought to focus your team. What would you say to him?
Look at impact fees. Impact fees are at the local level costs that builders have to incur that are downstream from the local costs of a market. So impact fees would include such things as fire departments, police forces, schools, And because they're building new communities, they basically have to pay all the fees associated with having a community around it developed. And they could represent in California, they represent as much as 15+% of a home price. And they on average are kind of 5+% of a home price. I think that really, to reduce impact fees, and also the way FHA, the lines of FHA are drawn today, it's very difficult to understand how you can price where FHA is limited at the same price in Corona as you would in Victory, California, Victorville. So I think that the FHA limits need to be redrawn to look at it much more micro than the general Inland Empire and say, this is the limit for FHA, because pricing in Corona is very, very different in the more inland part. So those would be the two areas that I think would make a difference. And probably those costs that are being pushed to developers could be redirected elsewhere or picked up by the local governments.
So you could have quizzed me for your top 20 responses, and I wouldn't have come up with either of those. What I find to be really interesting about that, Ivy, is those two things are very doable. If you'd said to me, get interest rates down. Obviously, there are a million component parts that go into getting the cost of capital down and getting interest rates down to something where you unlock the existing home market, for instance. And so the idea that those two things could have such a big impact, I'm hopeful that this little clip gets out, gets to Scott Turner at HUD, who's coming in as the new HUD secretary, and other people to actually focus on those specific issues. Ivy, as always.
He certainly wrote a lot about it, so we can send it to Scott or anyone else, but I think that would really move the needle. But thanks for having me, Willie. Really appreciate the opportunity.
As always, a fantastic discussion. Thank you, Ivy. Thanks everyone for joining us today. Have a great week, and we'll see you again next week.
Take care.
Bye.